Hey Shane, welcome back. I know you had a little trip last time and happy to have you back here. So how was it?
It was awesome. I would recommend a visit to Israel for everybody. Something everybody's got to do, whether you're a Christian or not, whether you're religious or not. There's just so much going on, so much history everywhere you turn. There's like 2,000 years of history. It's pretty cool. But I got back like 5 days before a war started, so lucky me, I guess. Um, but I look forward to going back. I don't know how long it's going to be before we can do that. Um, But my experience, Israel was a very safe country, and all the different people, groups of people just get along really well despite living right on top of each other. So don't believe everything you see in the news. Obviously, there's some crazy stuff going on right now. But I think most of the time it's a pretty safe place to be. So
Yeah.
definitely happy. Every time I leave the country, I'm happy to be home despite all the issues that I see in America. There's still no place else I could see myself permanently living.
Yeah, we're pretty fortunate here. So glad to have you back. And for anyone tuning in, today is Thursday. It's October 26th. And mentioned the Thursday part because we're looking at a sell-off that's taking place right now. And I have rarely seen it rebound on Friday ahead of a weekend, especially with the world tensions that are happening. So interesting market we're in, but we'll
You
get
got
into
that
that.
right.
And yeah, so I'll turn it over here to our slide deck and go through and check that out.
Sounds good.
All
Yeah,
right.
hopefully everybody enjoyed the financial planning episode last month. That was cool. We'll look to get Ethan and Kyle or Ethan and Ken back on here from time to time as we go. So I'm looking for some format programming changes in the new year, perhaps.
Yeah, it'll be great. So, and with that, last week we talked about where stocks fit in a plan. And that's something important is that we can look at the market, try to forecast and talk about managing risk, but it also has a place in a portfolio. And, long term, if you buy dips, you'll probably be good 10, 20 years down the road. That's a kind of universal truth, but there are nuances to that and better ways to manage risk. And I think we're looking at one here. So, Shane, it looks like you drew the channel that we had the S&P in. So that's the shaded region. And now we are looking at, the price trending or trading below kind of everything here. We have 200-day average. It's under that. What are you seeing here?
Yeah, well, I might add to what you said before. Buying dips. I don't know if I'd go with universal. Good idea. I think you buy dips in bull markets. If you're in a bull market, that's when you buy the dips. When you're in a bear market, buying dips doesn't work. Even if it works for a short period of time, it doesn't really work in the long run because there's always a new low coming. And by my definition, we are still in a bear market that started at the beginning of 2021, and had lots of people feeling real good about buying the market, in October of last year, saying, "Oh, the lows are in, and now we're in a new bull market." Well, today it doesn't really look like we're in a new bull market. So I have been bearish the entire time. And here's the other thing, man, is like, if you bought the average stock in October of last year, you're actually not up. I mean, the S&P 500 benchmark index is up, but that's about it. The equal weight index is down, the Russell 2000 is down, and maybe not from October, but down year to date for sure. So everybody who was running around talking about their year to date performance or the year to date performance of the S&P 500 at the end of July, um, you know, I I don't know lots of people who go and put their whole stack in the S&P 500 when they say they're getting back into the market. Most people are either picking stocks or buying a diversified portfolio of large caps and mid caps and small caps and internationals and emerging markets and some bonds. I don't even have a bond chart in here, but bonds are crashing. We probably should have put a bond chart in here because man, I would not want to be in bonds right now. But so there you go. I mean, so back to what I was originally saying is like buying dips in bull markets is a great idea. But if you're not in a bull market, be real careful about buying those dips because markets will crash from those dip levels, right? It goes down and then wham, it goes down even more. So we had a nice series of like higher lows and higher highs, and we got back above the 50 and the 200 day and so on. But we never took out the old highs. I don't think we ever got out of a bear market, and the economic data that we see, other than the heavily manipulated GDP data, um, all still looks pretty bad. So the channel that you were mentioning that you see on there, I mean that channel we've been watching it, probably since March or April maybe, and we broke out of it to the upside at the end of July, and then ran into that resistance at the orange line there, but around 457. And ever since then, it got back into the channel and now it's broken down to below the channel and below the 200-day moving average. And I basically just left the drawings as they were in my last market commentary that I wrote. So that red arrow that says lower high with a question mark on it, that was in my commentary last month where I was like, hey, are we going to get another lower high here? And you can see it didn't even make it to the trend line. It kind of got blocked by the declining 50-day moving average, the red line. And so didn't even get like a big bounce off the 200-day moving average. It's a super weak bounce. And I know you see it, Kyle, but this little retest of the 200-day and failure right there, that's like about as bearish as it gets.
Yep. And that's when I'm doing my own trading is when you look for levels like that where you break support, come back up, retest and fail. That is about as clear as it gets of an indicator. And what you have to keep in mind now is that everyone that bought up here, above that level, as well as kind of that market top from the year prior, they're looking to sell because now they're scared. So now you just have a ton of what's known as overhead supply. So yeah, every rally now you're probably going to might see some more selling pressure, and that's a
Hmm.
tough environment.
Yep. Looks ugly. A lot of earnings have come out, not very good. Google got smoked on its earnings report, down 10%, and is down another 3% or so today. Last time I looked, and yeah, down 2.67. Apple's testing its 200-day moving average. In fact, as of right now, it has dropped way below. So Apple looks just like this, and it's no surprise that, so goes Apple. As Apple goes, so goes the market because it makes up most of the market. The Magnificent Seven are all getting rocked. So there's just nowhere to hide. I think the economic realities that I've been writing about all year are finally mattering. And
Hmm.
look, I'm not going to be surprised if we finish the year down. Like I will not be surprised if we finish the year way down here somewhere, which would be, down slightly from where the year opened.
Yeah.
I'm not saying that's my base case or that's what I expect to happen. I'm just saying if that's what happens, I will not be not even the least bit surprised. It's totally possible. And given the economic backdrop, it's probably warranted. So,
Yeah, and I
um,
think a couple factors that play in there is usually the last quarter of the year is where you would either maybe see a Santa Claus rally or you can see it trend pretty hard the other way. And it doesn't have to be one or the other. I mean, hey, we could move sideways, but you can definitely get some exaggerated moves into the end of the year. So
yep,
I'm with you there. Right now, I think until we find some serious support and build a base again, right now, to me, it just looks like charts are catching up with fundamentals. And fundamentals, we've known this, all year, they don't look good.
yep. So even Kyle's bearish now, if you guys didn't pick that up.
I am. So that's Shane. I always like to have the bull case. And so, what is the bull case here? Wait, we've broken these levels. There's going to be some good entries here for long term. But right now, if I look at charts, the ones that were setting up to break out broke down. That's not good. And what you're seeing is treasury rates just keep going higher because nobody wants to buy the bonds. So that is that ruins every technical pattern you can think of when you have interest rates going higher the way they are.
Yeah, we'll get into that a little bit more on some upcoming slides, I'm pretty sure.
So with that, we'll step on over to, you know, we've been looking at GDP that came out today, and it was a surprise one, wasn't it, Shane? And kind of what's his takeaway there?
I guess it wasn't really a surprise to me because the Atlanta Fed has their GDP now tracker that, they put estimates out all quarter about what they think GDP is going to be when it finally comes out, and they were over 5% for most of the quarter. Um, and so I'm not surprised by it, but I think I don't know. In what ways are it manipulated exactly? I couldn't tell you right now. I haven't really had a time to write and wrap my mind around it, but what I can tell you for sure is that, Jerome Powell and the guys at the Fed have said, for a while now that the in order to bring inflation down for real and for good, it's going to require a period of sustained below trend growth. And GDP's trend over the long run is like around 2% per year. And 4.9 is way above trend. So so this to me just gives the Fed more permission to hike rates or just keep them higher for longer. Right now, I think the market's not really pricing in any more hikes, but definitely not pricing in any cuts anytime soon. And so the longer that rates stay high, the more likely it is to play out in asset prices. Certainly bond prices are reflecting it. I think part of the reason that the Fed won't have to raise is because bonds have already dropped so much and interest rates have gone up so much without the Fed having to tighten more, that they're kind of they're they have a little bit of cover to wait and see what happens. So, um, apparently the consumer accelerated spending in the quarter, the most since 2021. This was kind of a surprise, I think, to most of the market. I don't know where people are getting this money. Perhaps they're just running up more credit card debt, which is kind of reflected in some data that I've looked at. Highest credit card balances in history, highest amount rolling over from one month to the next because people can't pay off the bill in full at the end of the month. Those numbers are up at all-time highs. So I don't know how long this can go on. I do remember though, back during um, the great financial crisis and the mortgage issues, like mortgages really started to slow down in like 2005, and it wasn't until 2008 that things really, got bad. It took some time for the banks to get all the toxic assets off of their balance sheets and all the backdoor deals that were going on. And once they finally got positioned for the crash that was coming, they let it crash. And some of the banks didn't make it. Obviously, Lehman Brothers and Bear Stearns didn't survive, um, but others did and had the capacity to pick those up on the cheap. So
Hmm.
I don't know that this time is much different. I think like everybody sees what's going on, and we're all wondering like, why is the market not getting killed yet? And then eventually, it'll probably happen, and we'll all look back and say, well, geez, that was obvious. So anyway, GDP very strong, abnormally strong for now on the back of consumer spending, and we'll see if those people are able to ever pay off their credit cards, or if they just end up bankrupt. Because student loans are due now too. So student
Yep.
loan debts are accruing again in October. First payments are due in October, and so I just don't know how people are keeping up.
No, it's a tough situation. And excuse me, one thing Shane and I, we were joking about it before this call, but the difference between an economist and a money manager is that an economist can be right in terms of looking at these variables, determining, what is going to happen, and they're never wrong. It's just their timing is wrong, right? So that's kind of where they sit. But then over on the money management side, you see these fundamentals coming, but the job is manage the risk. And, we see what's coming, but then the market, it could always rally higher like we saw, but then you can see it roll over too. So it's always a active job of, manage that risk and see what the market's doing and is the information kind of translating over. So,
Hmm.
and then this is the one, Shane, and I hate this chart, to be honest. You never want to see credit balances going up, but that is what we're seeing here.
Well, that's cool. I
Um,
didn't even know that this one got left in here. I'm glad it's here since I started talking about that, but holy moly. Yeah. Sorry, I didn't mean to interrupt you. I didn't know this chart was in here.
all good.
But finish what you were saying.
Yeah, so, you know, looking at this, you've got credit balances going up. And usually, let's just talk about a house, right? You can refinance. Let's say you had a 5 or 6% mortgage and 2020, you could have gone out and refinanced that thing for 3%, and now things don't look so bad. But you're not going to refinance now because the rates are not going down, they're going up. And it's probably going to be a little harder to get financing, even if you could. And what we're seeing here is, was it credit cards? Is they've gone up a little bit. The main one was it credit card limit here
Hmm.
that's just kind of going through the roof.
Yeah, crazy, right?
Mhm. But that is one where, yeah, you want to talk about driving a good economy. Hard to do it when people are sitting on credit card balances like that.
You know what trips me out about this chart is kind of, and I don't, maybe I should do some math and add some stuff to it before I write the commentary and maybe put this in there. But let's see, I'm just looking for it. So back in 2008, 2009, you had the HELOC balances, which got crazy, right? They're all the way up here relative to the credit card balance, which was only like right here, right? So there wasn't a whole lot of room in between the amount borrowed on HELOCs and the amount borrowed on credit cards. Fast forward to today, yeah, there's a lot less home equity line of credit balances outstanding. But my goodness, look at the gap between that and credit cards. So like this, I mean, I haven't really gamed this out, but like back in 2008, 2009, when people filed for bankruptcy because they couldn't afford to pay their HELOCs back when housing prices fell, at least the bank had a house that they could go take over to
Hmm.
like recoup some of that debt. These credit cards are it's consumption. There is no asset behind it. Like there's nothing if you're the bank who has lent that money on credit card to these people who have used it and they can't pay it back, you have no recourse. This isn't an auto loan. Like there's not a car, there's not a house, there's not a property, there's nothing. It's just gone. The money's just gone. So I don't know. To me, like that is a bit of an anomaly. Like that amount of gap is not something we've ever seen, going back to I guess this goes back to '03, and this comes from the New York Fed, which I think this is through the end of second quarter. So there's a new one coming out next month. We'll see how it looks, but I mean, I don't know. To me, that's terrifying. If people default on that, there's no recourse. Like it's just the money's just gone to money heaven. Bye
Yep.
bye.
Yeah, it's something else. And I'm a little surprised too is that the HELOC balances didn't go up because you did have a period there where interest rates were so low,
Right.
where it may have made sense and home values were going up, so you had more equity to access.
Hmm.
So maybe the
Yeah.
consumer was a little wiser on that side, but the credit
I'm
card now is looking like that might be a bit of an issue.
I'm super surprised the HELOC balances aren't higher. Like it blows my mind that they're not higher. I'm really really surprised.
Hmm. So, and then here is our other person that is not responsible with the debt, and this is the U.S. Treasury.
Yeah.
So, and the one thing I just want to hit on this at high level, before we get into this, is that while a bond, it has some sort of like an implied guarantee, right? Secured by an asset, you can go try and get repaid. But, every asset out there has to have a buyer and a seller. So if there is no buyer of whatever you have, whether it's Dogecoin, treasuries, stock, then that value could be zero. Who knows? And that's something we're seeing now is, the Fed was the biggest buyer of treasuries, and now
Mhm.
they've stepped away. And here's some of the upcoming maturities. So what are you seeing, Shane?
Well, right now I'm actually trying to buy to close some Apple calls because Apple's getting smoked today, and we sold some covered calls against it, and I'm trying to close them. So give me just 2 seconds.
You've
to
got it.
enter this order. 0 point. I'm buying these calls back at 16 cents. I think we sold them at $1.50. Not bad.
That is a
Not
good trade.
bad. Yeah. Putting the money in the pocket. All right. So anyway, yeah, I mean, like you're saying, like somebody's got to be able to buy it. Like they're gonna have to refinance 31% of the government's outstanding, the country's outstanding debt in the next 12 months. And they're going to need somebody, um, to buy those new bonds that are going to be issued in order to refinance it. And when that happens, people are going to demand an interest rate that corresponds to what current interest rates are. So, this outstanding debt is probably at, 1.5, 2%, something like that, 3%. I don't, even if it's four, whatever, they're going to have to refinance it at current rates, and that'll depend on, what the term is, how long they have to pay it back, all that kind of stuff. At the end of the day, um, the Fed's not buying bonds anymore. They're not printing money to buy bonds to keep our interest rates artificially low. Another thing that has happened over the past several years, which we don't have a chart for in here, but I'll probably put it out in my commentary, is that foreign purchasers of our national debt have been, pretty much in like terminal decline for, I think, since about 2015. So for almost 10 years now. Um, is that right? I guess the peak was like, yeah, 2015, 2013 even. So the Chinese government and the Russian government and the Brazilian government, they used to buy a lot of United States paper because it was safe and there wasn't crazy inflation, and you could count on the United States not to just print so much money that it made the dollars worthless, right? And you can't count on that anymore. Like after what's happened since, Trump is the one who actually signed the CARES Act, for everybody who wants to blame, only the Democrats for spending so much money. um, the Republicans are just as guilty. They approve all these budgets that are totally imbalanced, and they're all addicted to spending. Nobody in government has the appetite to cut the spending that's necessary in order to get our finances back in order. So guess what? They're not going to. They're just going to keep spending money, and they're going to keep borrowing money. And the less people that want to buy that debt, the higher the rates are going to go. So the only way out of this ultimately is for the Fed to start printing lots of money and buying bonds again. That's the only way out. Otherwise, probably the government defaults on its debt. Um, and so I don't know if or when, I guess I don't know when that will happen, but when it does, when the government starts printing money to buy bonds again, inflation's going to go up. It's going to skyrocket. So, I've been talking about it for, I don't know, many months, several months, more than a year, but the government is there's no palatable option, right? There's like, people say they're cutting spending, they're gonna if politicians say they're gonna cut spending, they will no longer have a job because people have gotten used to all the free stuff. So they're not going to do that, and we're not going to be able to afford the interest on our debt soon. So the only way that we'll be able to pay it is by printing more money. When we print all that money, it's going to cause inflation to skyrocket, which it's just a vicious cycle that there's really no I don't see any real way out of it. I think the whole game is to see how long we can continue on like this before things get really, really, really bad. And wouldn't be the first time in history that, the world reserve currency changed or something like that. It's not like the world will end, but someday, if dollars are no longer the same value, it's going to take a lot more dollars to buy stuff. And yeah, I don't know. I mean, I don't mean to be all doom and gloom, but in the long run, this does not look good at
No.
all.
And I think it's unfortunate that there are two solutions. One is government starts spending less and manages a budget, and unfortunately, we just can't count on that. Um, the other one is print dollars, and unfortunately, that has its own consequences as well.
Yep.
And speaking of the dollar, here's a bullish chart that I don't like to see unless maybe I'm vacationing, and that it looks like a strong dollar.
Yeah, so I mean, going back to what I just said a minute ago, don't mistake me for being like the end is, the end is near guy with my little sign ringing my bell out on the street corner. Like, as of right now, the dollar is ripping higher, and uh, since the euro, I guess the European Fed, the ECB, uh, European Central Bank, they decided to stop hiking rates yesterday or today, I don't know, overnight, for the first time in like 15 months or something like that. And so the slower that the euro raises interest rates on their end, the higher the dollar is going to go. And so in the near term, the dollar is the nicest house in a bad neighborhood, and people are still going to use it and flock to it. And the higher interest rates go in the US, the higher the dollar is going to go, because people need to get dollars in order to buy those US bonds. All this stuff is so interconnected, which is why, like we were saying earlier, no thanks on being a macroeconomist. I want nothing to do with it. I mean, I take all this stuff under advisement, but I like to look at prices
Yep.
because they don't lie. So I just look at prices of companies for the most part, and I take all the macro stuff as kind of background noise that inform my overall allocation decisions. But ultimately, the dollar going higher and interest rates going higher spell lower asset prices for stocks and bonds and other things in the United States of America, including, houses, eventually. So I don't know, it's amazing to me how well housing has held up, but it has begun to come down. Median home price sales have kind of tanked. Um, and so we'll see how that plays out. Home builders have definitely started to roll over. They've pulled back big time from their highs. And the higher mortgage rates go, which we got a chart for that somewhere. The more pressure we're going to see in home prices. So anyway, the dollar going up is great if you want to go on vacation to Europe, or, like Kyle said, anywhere where it's not dollar denominated. Um, but if you're staying home, it's tough, and it's tough for companies that are making a lot of their revenues overseas, because when they translate, you know, if Apple sells a lot of phones in China, and then they got to take all those Chinese yuan profits and convert them into dollars, they become worth, a lot less. Those Chinese yuan buy a lot fewer dollars than they used to. So that's why you always hear and see companies adjusting for foreign exchange in their reported numbers, because
Yep.
they don't want to report the reality.
And then,
So,
Shane, one observation I made that's been interesting, and sometimes I'm a bit of a gold bug in my own personal endeavors, which maybe I shouldn't
not
be, because,
you.
but a strong dollar and higher interest rates are the worst two things for gold, but gold
Yeah.
has actually rallied some. But
Hmm.
we always talk about it being a chaos hedge,
Yeah.
and right now you've got instability in the world, especially just with what's going on in Israel. Historically, the return on gold not great at all, but just surprised that it's holding in there the way it is. So,
Yeah. Lots of chaos to hedge against right now, for
mhm.
sure. For sure. Lots of known unknowns.
Yep.
Like,
And
there's nothing like secret about what we're talking about today. The whole world knows this stuff. Like, anybody who doesn't know that the United States government is absolutely bankrupt and insolvent without a printing press for dollars. I don't know, like, you have to know that. It's just like common knowledge. So if we ever lose the ability to print our way out of it, either because people don't want the dollars anymore, or because the Fed refuses to spike inflation again, right? It doesn't mean that we have to lose our reserve status in order to not be able to print money anymore. It's like, hey, if you print more money, inflation's going to go to 10% again. That right there will stop you potentially from printing more money. You no longer have the ability to just print your way out of a big debt load. So it might be a self-imposed situation that causes us to not be willing to use the printing press anymore, which would be great, you know? I mean, economically speaking, it would not be great for people living their day-to-day lives. It would be very painful. But that's the situation we're in, and it's nobody's fault but everybody who votes. It's your fault. So guilty, everybody's voted, and we all somehow vote for people who will just keep refilling the punch bowl. Even
yep,
though it's bad for us in the long run, it's really our children and the next generation who are going to pay the ultimate price, I think. So we'll see.
yep. And then, right now think or talking about that next generation, those who came out, they've got a job now, they want to go buy a house. We're looking at mortgage rates. I thought they hit 8%. So,
Yeah, this is there's a couple different measures of mortgage rates. So this is just one that I got from tradingeconomics.com. It's the Freddie Mac rate. I don't I've heard people talking about mortgage rates over 8%. I haven't seen it on a chart and I haven't taken a mortgage at 8% personally, so I can't say for sure what that is related to. Because what I see is, the highs are where we are right now, which is about 7.63% on the Freddie Mac. But there are other measures of mortgage rates, and maybe they do say over 8. I know that Kyle and I were talking back here that we said, hey, if it holds there for a while, fine, but then it's going to go up, and the next stop is about 8%. We said that like in April of 2022,
mhm.
and it's played out almost exactly as you and I expected. And you didn't you get a mortgage like right around there? Didn't you
I was
nail it?
I wouldn't recommend this for anyone, but
Mm.
yeah, I told my mortgage broker to hold off locking the rate in, and I caught that little dip right there. So,
Mm-hmm.
it was a good trade, but yeah, from there it's just been
My more
relentless moving higher.
my mortgage rate is right about here, 2.97. Yeah.
And
Uh
you'll
my
never be
wa-
selling that
that's
place.
what I told my wife, we're here forever now. We're here forever.
So,
Um yep, that's what's happening.
hmm yeah, not a good time. And it's fine to rent. It doesn't put you behind to rent. So if you're
Not
out
right
there
now.
and looking for that first house, this is a time where renting is not such a bad idea.
Yeah. Tell you what is a really bad idea is buying a house to rent it out as an investment property. The economics on that have never been worse. You would be much better off buying a U.S. Treasury bond.
hmm And then, the other thing is just treasuries. We talked about yield curve inversion, and it was this weird world where you got paid more on the time frame. So, I could go invest my money in treasury 6 months and get paid more than I would for 10 years. Looks like now we're finally coming back to an equilibrium point. What do you see
Yeah,
in there?
for over a year, going all the way back to July of 2022, the yield curve has been inverted. So you could get more interest loaning the government money for 2 years than you would get for loaning them money for 10 years, which, is just silly. It doesn't make any economic sense. And it's very difficult for banks to operate profitably in that type of environment. Um, but sort of paradoxically, the yield curve inversion, this right here basically starts a clock that says, hey, going in history, when the yield curve inverts, usually within 24 months, usually between 6 and 24 months later, the economy is in a recession. And paradoxically, what usually happens just before that recession starts is that the spread between the tens and twos spikes, and what we say is it reverts and goes back to being a positive rate. It does so usually in a kind of in a hurry, and then once it gets back to a positive level, the odds of a recession starting very soon are quite high. And so we're at 0.13, which is the highest level we've seen, like literally since just after the yield curve inverted back in July of 22. And so to me, this is ominous. This says, people aren't buying these 10-year bonds. Uh, so the rate is going back up, right, to attract those buyers, which means the price of the bonds are going down. So if you have bonds in your portfolio, say you're in the 60/40, tried and true pie chart prison portfolio, you're getting smoked this year.
hmm
Smoked. Your bonds for the second year in a row too, because it was bad last year. And this year you're not making any money back. So to me, what I'm watching here is I've been waiting for this thing to revert and get back to positive, and then the recession is probably imminent, and we are very close to that right now, which is in alignment with all the other data that I'm seeing. When I look under the hood, so I think I was telling the team, I don't know, yesterday. It must have been yesterday. That I think I'm probably more bearish now than I was in the summer of 2022 when we decided to sell half of all of our holdings and put half of our money in cash. That was before treasuries were paying 5%. Now they're paying 5%, so it's like even better to hold on to all that cash. And I think I might be more bearish right now than I was last summer,
Hmm.
and we know how things turned out last year with the market, down about 20%. So I just if you're out there managing your own money, I think that um look, if you want to be able to buy a lot of really great companies at the bottom, you want to be able to buy when there's blood in the streets, like Warren Buffett says, and all that kind of thing. You got to have cash. There's only two ways to get that cash. Number one, save more. I encourage you to do that. But a better way is to sell stuff ahead of the recession. So if you sell stuff now, sell some winners, sell some things that have bounced a whole bunch this year. So if you got Nvidia, trim that sucker, like take a little bit of profit off the table on some of the things that are up a lot, especially the ones that don't deserve to be up a lot. And those there's really only seven stocks in the whole market that are up a lot, right?
Yep.
Um, so I mean, sell some of those dang things, which is what you're seeing happen over the past couple of months, and buy some treasuries that allow you to short-term treasuries, right? 3 months, 6 months, 2 months, whatever, and keep rolling them over until the recession hits and the market drops, and then you're gonna have some cash available to actually take advantage when there's blood in the streets. But if you don't do that, if you hold on to all your stocks and don't ever touch them, and you just got like a shoebox full of baseball cards, you will not be able to take advantage of the prices that, we would see if the recession and market drop play out the way that me and a lot of other really smart people kind of see coming. So,
Yep.
um,
And I think that's where, if it is a bond that you're going to buy or a cash alternative, short duration. So what that means is something that matures in less than a year. You're not going to see as much volatility. And then the other thing to note too, just, Shane, in reference to your comment, you haven't been more bearish. You did make one bullish comment today, and that was me being just as bearish as you. So,
yeah.
maybe that was an indicator, but you and I are heavily in the bear camp right now, and I don't see any support for a bit. Fundamentals don't look good, so not the least bit surprised if we watch this market kind of just get taken to the woodshed over the rest of the year.
Yep.
And then here's, back to that credit card idea. This is telling me, so Google Trends, anyone who doesn't know, this is new to some people, is that you go to Google to search for a lot of things and things you don't tell your friends about. Maybe you've got a problem that you want to keep secret. That might be a credit card balance. And you can actually go pull the statistics to see how many people are searching for that term. And this is a huge uptick in people that are trying to figure out credit card balances.
Yeah. Yeah. I mean, this is the search term right here. Can't pay my credit card. And people want to know what to do. They don't want to call their financial advisor and ask them. They don't want to call mom and dad and ask. They don't want to call their best buddy and say, "Hey, I can't pay my credit card. What should I do?" So who do they ask? They ask Uncle Google. And then we can go find out from Uncle Google what people are searching for. And no surprise that this is happening in October, the first month that student loans are due again, because people got to choose. Do I pay back my student loan or do I pay my credit card? Assuming you can pay either, some people probably can't pay either of those. And, there's programs to help some folks and things like that. But, at the end of the day, if you agree to borrow money, that's a contract. It's a social contract and a legal contract, and you shouldn't borrow money that you're not willing to pay back. It's just there's no principles anymore, and it's nobody's fault, but you shouldn't take out debt that you can't afford to pay back. And at the same time, you shouldn't lend money to people that you don't think can pay it back. Like that's just the way economics work. So,
Hmm.
the way that student loans are, government guaranteed and all this kind of thing, it encourages bad behavior, moral hazard. And it just sets people up for failure. I mean, how much money are you really going to earn for a $200,000 liberal arts degree or something, or gender studies? Like, good for you. You want to study that, but like, probably don't take out $200,000 worth of debt to go study it at Harvard.
Yeah.
It's probably not a good economic decision, and it'll stick with you for the rest of your life. So, yeah, I think this is indicative of the world we live in right now. I mean, delinquency rates on auto loans, on mortgages, on credit card debt, all that stuff is ticking higher. And so this was just like really eye-opening because I mean, it's even, yes, there are more people on the earth than there were, back in 2009, 2008, 2009. And yeah, more people are connected to the internet and, all that kind of thing. But still, there are more people, you know, that can't pay their credit cards today than there were during the great financial crisis when, 3 million people ended up homeless.
Yep.
So to me, it's terrifying. We'll see how it plays out, but it's absolutely terrifying. So, um, I think we
Th-
want to wrap it up, but there was one other thing on the list that I just wanted to mention. And it's a little bit more of a financial planning kind of topic, but it's easy. Um, and it applies to trading too a little bit. But this time of year is when we normally start looking for tax losses to harvest for our clients. So if we own a stock that's down for the year, and it's in a taxable account, and our client is going to have a large tax bill already, what we'll do is we'll look to sell that stock that's down and stay out of that stock for 30 days so that we can record the losses in that stock on the client's tax bill for the year, and that client um, will not have to pay as much tax as he otherwise would. And so there are some companies, I don't know, I can't think of one off the top of my head that we're going to do that with, but just for example, um, if you bought, say, Hershey this summer, and let's see, I'm on a weekly chart here, but let's say you bought Hershey in May or June of this year when it was near its all-time highs of 276 bucks. Well, it's now down, 30% from those highs. And if you put 10,000 bucks in it and you only have 7,000 left, you can sell all your shares of Hershey and you'll get to not pay taxes on that 3 grand. Okay? It'll reduce your tax bill for the year. Uh, in the meantime, you got to stay out of Hershey for at least 30 days. So, if you don't want to do that, be careful. You can, however, go buy something very similar to Hershey. You could find a stock that has a very high correlation to Hershey. Or you could find something like the Consumer Staples ETF that has a fair amount of Hershey in it, and buy that, for a month in case you're worried about a big bounce. Or you could go buy Nestle, right? Nestle, same kind of business. Or Tootsie Roll is another, candy business. There's all types of ways that you don't have to stay out of the market completely for 30 days with those dollars. You could go get some exposure, in something pretty similar, and then buy Hershey back, 30 days later, depending on how things go for you. So, just something to think about. Now is the time because a lot of times, like in this year, the market started rallying right when the calendar flipped over to 2023. The market started going up a lot, and some stocks were recovering. So, if you got to stay out of something for 30 days, end of October into November is a pretty good time to do it because that way you can get back in before the end of the year, and you get to realize some tax losses, but you get back into the stock before the year is over in case it comes out of the gate strong in January. So we like to harvest tax losses this time of year. And here's the other thing that is important to note is if you know that that's a thing, if you know that people are going to look for stocks that are down the most this year and then sell them, what, Kyle, what happens to the prices of those stocks that are already down if a whole bunch of sellers show up all of a sudden?
They go down a lot more.
They go down further. So this is why during this time of year, between now and say like December 15th, when people start buying those stocks back, the losers, the losers of the year tend to crash this time of year because everybody wants to realize those tax losses. So even if you're not going to harvest any tax losses, maybe you're looking for something to short. It's counterintuitive. A lot of people say, "Oh, you want to short something when it's at its high. You want to buy, you want to sell high and buy low kind of thing." Well, This time of year, if you know what's going on behind the scenes in the form of tax loss harvesting, you want to go find things that are down a bunch and short those because they can crash from being down a lot. They can absolutely crash. So just a trade idea that I think tends to work this time of year. It's something I'm always on the lookout for.
Yep. Trade idea. And then also just managing taxes. Remember, if it's a taxable account, that's where tax loss harvesting happens. If it's a retirement account, those are not taxed during the year. So it does not occur there. But, helpful information to know, not only from a trading standpoint, but also if you're just kind of managing your portfolio and you want to manage your tax situation, that's something to look at.
Yeah, and if you have questions or want help with that, I know of a firm that does that kind of work. It's called Elevate Capital Advisors. There's probably a link down there that you can go visit our site, give us a call if you want some help with that type of thing. So
There is. So awesome. Well, Shane, thanks for taking the time. Glad to have you back again. And, we'll see where we end up here. But I think as the year carries on a bit, we're going to see volatility. I know that. So I'm looking forward to our next chat.
bring it on, man.
All right. You have a good one.
See ya.